So you want to get a lower interest rate on your mortgage. Doesn't everybody? And I can tell you that there's a lack of understanding among borrowers or home buyers as to how your interest rate's determined. I've done a video on that. If you want to check that out, I'll put that at the end or in the description below. But what this video is going to be about is how to get a lower interest rate. And so I think it's important to understand various steps and what lenders can actually do to impact your interest rate. So the first thing, and I've mentioned this before, is your credit score might be the largest, most important factor in your lender being able to get you the lowest rate possible. So this one is on you. You need to make sure you're taking care of your credit. And if you're needing to apply for a mortgage today and you realize, oh, my credit score is only 600 or 620 or whatever it is, not that you can't improve your credit in a short amount of time, because there are some things you can do. And I am providing some improve your credit score tips videos if you want to look at some of those. But you needed to start working on that a while ago. So, but like I said, the first thing is your credit score. I've seen lenders' rate sheets where the difference in your rate between 700 score and a 600 score is sometimes as much as 2% or more, depending on the type of loan program. So your credit score is a big deal. So when I get a phone call from someone who says, what are the rates today? There's so many factors that go into that, and it's like going to a car dealer and saying, what is the cost of a car? It's a little bit similar in that there's so many different options. And so when you're comparing rates from one lender to the other, it's almost like looking at on an online ad at a car price, and you see, let's say a Mustang that's priced at X, and then someone else is advertising a Mustang and it's priced at Y. Well, you don't know, how the auto dealer's arriving at this price and the other one's arriving at the other price. There could be different options, different things happening. So you really need to dive into it and understand what's building the rate. So again, the first thing is credit score. If you can improve your credit score, you've got the best chance of getting a lower interest rate. The next thing is your down payment. Unless you're shopping for an FHA loan where the down payment is always going to be 3.5% for a credit over 580. The more money you put down, the better the rate will be. And all these things between credit score and down payment is a lender's way of rewarding you for reducing their risk. It's the best way I guess you could put it. So the larger the down payment, the better the rate will be. And these lenders have a rate sheet and a grid and a matrix that kind of indicate to them, based on all the different your particular factors, how that adjusts the rate. Another way to get, in addition to making a larger down payment, the other thing that you can do is potentially pay discount points. So you hear about points, and some people have a lack of understanding as to what that is, but a discount point is exactly that. It's a discount off of the rate. So if you pay one point is 1% of the loan amount. If you pay 1% of the loan amount, that's 1 point, your lender should then in turn be delivering to you a lower rate in exchange for that. Because lenders are compensated essentially based on the rate that they're offering you. And so if they're going to lower the rate, you need to pay a point or some money or in fees in a sense to help offset the commission they're going to lose by giving you that lower rate. So what you'll do is you'll look at that over time and say, does it make sense for me to pay on a $200,000 loan 1 point, $2,000 to get a lower rate? How much is my rate going to be lowered? Is it a half point or is it a quarter point? What is it? And then what is that going to save me each month in interest for that lower rate? And how long will it take for me to pay off that discount point that I'm being charged for the lower rate? We're going to dive into that also in another video, so can't cover everything at once. So paying a discount point could be one way to get a lower rate. And by the way, when you're looking at rates advertised, you might have one lender whose rate's here, another one who's here, and you're like, wow, this lender's got a lower rate, but what you don't realize is they might be factoring in a discount point to get you to that rate when the other lender isn't. Then you need to also, if you want to get a lower rate, ask about different loan programs, like an ARM product, a 5-1 ARM, 7-1 ARM. Is it going to lower your rate? And if so, by how much? And of course, that product needs to make sense for you too. You need to know that you're going to be in the house only a few years, so that way you're not stuck there if the rate adjusts up 5 to 7 years later. But the other thing is ask yourself, while we're talking about programs, is the rate really what's most important to you? Or is it that you want the lower rate just so you can have a lower payment? Because if that's the case, then speak to your lender about ways to actually get a lower payment. So for example, maybe your lender offers an interest-only option for the mortgage you're looking for, and there's a lot of you can speak to a lot of people as to whether an interest-only loan is a smart thing or not, but it can lower your minimum monthly payment requirement. And let's use this as an example. A $200,000 or $300,000, I forget what example I was running on the Excel spreadsheet earlier, but maybe it was a $200,000 loan. Let me just see here, make sure I'm correct. It was a $200,000 loan, and we were talking about an interest rate of about 3%. Your interest on that payment is going to be $500 per month, but the principal portion of that would be $343. So if it's an interest-only loan, then your payment will only be your required payment will only be $500, and you'll be able to save $343 in principal payments every month that's not required for you to make. So that's a way to reduce your payment, and that's not a bad thing to look at if you don't feel like you're going to be in the home for very long, and you wouldn't have paid down much principal anyway over the next few years before you move. So that's potentially another way to go. Rather than really just shopping hard for interest rates, you shop hard for the right program if you're looking for a lower monthly payment. So after you do all of that and you have an understanding as to all the different things that you can do to get a lower interest rate, then you can shop for your lender. And now you should ask your lender, what's the rate with your standard fees, and then understand what their fees are. They might have an origination fee, an application fee, all these different things. And you can add them up and make sure you total those and weigh those against the other lenders that you're going to interview. And then ask for their rate without fees. No fees involved, what's your rate? And jot that down. And then ask for the rate also with a discount point. So then you can then take that and shop those with all the other lenders that you are interviewing or researching online. So that way you're doing it apples to apples. So you understand that this lender's giving me a rate quote and there are no fees included, and this one is giving me a rate quote and they've got a discount point included, and you can get confusing. So you have to ask those specific questions to understand what's involved, so that way you're measuring them apples to apples. And speaking of apples to apples, you also need to give them all the same information. They need to know the same about you that all the other lenders know about you. So for example, if you've had a recent bankruptcy, it's important because that's going to impact your rate, and you need to tell that to all the lenders before you get the rate quote from them. Or if you cannot fully document your income and you might need a bank statement loan, it's totally different, and so they all need to know that. They all need to understand what they're working with, so that way they can give you the best rate possible. And then finally, when you're shopping for a lender, the interesting thing is right now we're in a situation where there have been a lot of refinances over the last month with the little bit of a stock market crash, and the Fed lowered the rate down to 0, and everyone went out to refinance. And so, in theory, you'd think that rates would end up being really low, but all the lenders' pipelines got jammed, and they were so busy that they didn't need to be as competitive to lower the rates as much as possible. because they had so many customers they couldn't even manage them all at one time. So the supply and demand for the lenders for business potentially also impacts the interest rate. So let's hope that that gives you a little bit more of an understanding. If you have any questions, just leave those questions down below in the comments, and I'll do my best to answer. And like I said, you can see some of my credit score tips videos if you wanted to improve upon those, which is the first thing that I mentioned at the beginning. And it would be great if you would hit that subscribe button so that way you can see more of the videos as I release them. Have a great day.